Since 2020 was so rich in crazy news that turned the world upside down and showed us that indeed life can be as captivating as the movies, 2021 could not disappoint and started off with a bang in the financial sector. A coalition of Redditors took on the big boys on Wall Street and made a struggling company stock blow through the roof with a clear aim of going to the moon, making the hedge funds lose billions of dollars in the process. A modern tale of the rich being left to hold the bag by regular folks banding together, and an intriguing one in a world where chances for these kinds of stories become less and less likely.
This battle is not over and the saga is still ongoing. If the hedge funds win, they will make a ton of money. Thousands of people will lose their jobs and the retail investors will lose their shirts. If the merry band of upstart investors wins, a lot of regular people will come into new money. Wall Street firms worth billions will be in big trouble, so big that it might crush the American economy. It made world news, and as always, most people got a general idea, took sides, and tuned out without delving deeper, while the experts on the news either struggled to explain the situation properly or blatantly misinformed the public about what was going on.
Hell, like most, we struggle to get how financial markets work and what their purpose is, and we definitely don't own any stock. But this story sparked a thought. Why is this subject so nebulous to regular people when our economies and our livelihoods depend on the health of these markets? The experts and politicians tell us that a strong market means a strong economy. But is that really true? Let's try to find out together.
Though trading in stocks and securities had precursors in France and Venice in the Middle Ages, the first stock market, as we might recognize it today, appeared in the Netherlands in the early 17th century. Trade ships were traveling to the East Indies to bring spices to market in Europe, but it was a risky endeavor. A trip could last years, and innumerable disasters could doom an expedition. But even so, the risk was worth it, because a successful trip could earn the owner of the ship and his backers an immense profit. Owners started selling shares of an expedition to spread around the risk, and these shares were traded on the market.
The venerable Dutch East India Company was created to distribute this risk even more. Investors could now buy shares of multiple expeditions, and not only for one ship. The VOC's model brought them enough profit to create the world's largest commercial fleet, making Holland one of the richest nations in Europe. Worth mentioning that the slave trade was a great contributor to the creation of this wealth. Not to be outdone, Britain soon created its own exchange and trading companies. One of them was the South Sea Company. It sold shares even before mounting any trade expeditions, actually before it had any ships.
With the backing of powerful political figures who talked up the great riches the company would bring, the stock's value exploded to hundreds of times more than its original price, as more and more people bought in. This was one of the first stock market bubbles, where stock's price is inflated to values far beyond a company's worth. Of course, early backers who knew that the company would never launch a single ship got out early, and with a tidy profit leaving many others penniless when the stock eventually collapsed.
Since the 17th century, financial markets and the types of trades being done have gotten more and more complex. The basic reason for the existence of a stock market is for companies to raise capital for expansion. A firm decides to launch a new product or grow its network to a larger group of customers, and it issues shares in order to finance these endeavors, while spreading out the risk of failure among investors. If the action is successful, the company has achieved this goal without risking its own capital, while investors gain a profit with the rise in the company's market value. But at the same time, stock markets have been a venue for speculation, with more obscure financial products being used not for the growth of companies, but rather for the benefit of a few key players and to the detriment of regular investors.
Wikipedia lists over 50 stock market crashes in the last 300 years, ranging from small incidents with somewhat limited effects and catastrophic that caused severe economic hardship worldwide. On average, there has been a stock market crash every 16 years, and the frequency at which such crashes happen has been increasing in the last 40 years. The reasons for these incidents have been varied and complex, but two of the ones we are most familiar with, the 1929 crash that caused the Great Depression and the 2008 financial crisis, were caused primarily by speculation and artificial inflation of the market in the search for more profit.
In 1929, stocks became overvalued because nobody wanted to imagine that they would ever stop growing, so more investors borrowed money to buy even more shares. When these loans started to come to term, investors had to cash in some of their stock in order to repay them. And with more stock on the market, value dropped precipitously, putting most in the position of not being able to repay their loans, with disastrous effects that caused a global economic depression that lasted over 4 years. As a political side note, Hitler and the Nazi Party in Germany won narrow election victories in that period, mainly on the promise of economic rebirth in a country severely hit by the depression.
The 2008 crash happened for a similar reason, but this time it was the big financial institutions who gambled on infinite growth over a weak foundation. They packaged loans taken out by homeowners into nebulous financial products that they then traded on the market. The more money was made with these loan packages, the more loans were given out with less and less verification. When it became obvious that most of these loans would be defaulted on, the bottom fell out of the market. Wall Street institutions had to be bailed out by the government, and millions lost their homes and jobs. Of course, this was a new government trend where financial institutions got their losses covered with taxpayer money, while regular citizens who had just lost their livelihood were left holding the bag.
This recap is a big oversimplification. Reading the history of financial crashes and trying to understand how markets work can be daunting because it seems complex at first glance, but with a little time dedicated to it, it is something that can be easily understood as a mechanism. And with this understanding, it is very easy to fall into anger and ask, how the hell is this legal? When reading about the mechanisms that have minted some of the world's richest individuals. Take short selling, the mechanism that sparked the whole Reddit GameStop saga, and the practice that makes hedge funds an immense amount of profit.
Let's say a share is worth $2. A hedge fund borrows a share from a clearinghouse, promising to return it at a later date with interest. It then sells the share on the market for $2 with the expectation that the price will go down. At the scale of millions of shares and with some dark practices, like spreading negative rumors about the company that issued the share, the price goes down, let's say to $1. The hedge fund then buys back the share at a lower cost, returns it to the clearinghouse and keeps the difference. Worth mentioning though, that if the stock does not dip or rises, then the hedge funds not only have to incur penalties and raised interest, but also would have to eventually buy the stock at the current market value.
What happened in the case of GameStop is that hedge funds likely colluded to lower stock prices as much as possible, and betting on the company's failure. A company that employs 15,000 people. This has happened many times in the last 40 years. But a group on Reddit noticed that hedge funds were exposed so much in this short that an increase in the stock's value would not only bring them a nice little profit, but also put the Wall Street boys in a position where they could stand to lose a massive amount of money. As more and more individual investors piled in, the stock's value grew over 1,500%, and the hedge funds registered almost 20 billion in losses, and they will eventually still have to cover the stock they borrowed at an inflated market rate.
As of making this video, the story is still ongoing, and it has many threads. Retail investors are holding onto the stock to keep the price high, while the still exposed hedge funds are doubling down on their shares in the hopes of recuperating losses. There is media manipulation trying to get investors to sell, and the financial world is in upheaval. That is because regular people, united in a common cause, have proven able to disrupt decades-old financial schemes, even though the barriers to entry in this world are high for average citizens.
This story has also busted the myth that investing is complex and should be handled by an elite few. The complexity is purposefully created so that financial manipulation can be done without significant public scrutiny. In essence, it has been one more proof that the stock market is a casino for the rich that pays off only for them when it's doing well and screws everybody else except them when it's doing badly. In 2020, 20 million Americans filed for unemployment, while the stock market was trading at all-time highs. Many of these profits were made by shorting brick-and-mortar stores, hotels, restaurants, and other businesses that lost income during lockdowns.
So, after a pandemic where millions lost their jobs, while the market got government stimulus and did great, with the world's richest becoming even richer in 2020, is it worth still having a stock market? Maybe regulated?
With most elected officials receiving donations from the financial service industry, or the US Secretary of the Treasury receiving almost $1 million in speaking fees from one of the hedge funds involved in this scandal, that prospect seems highly unlikely in the near future. Regardless, regular people have proven that they can at least make a dent in a once impenetrable fortress. The forces against popular unity are strong, and this story shows that they are strong because the powerful are afraid, and they know we can defeat them if we come together. Maybe this battle won't be a victory, but it's a step for a better world for all of us. We have to become allies in a common cause and hold the line till we win.